All right, welcome everyone. Thanks for tuning in to this month's SignatureFD webcast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer here at SignatureFD. Now, for those of you calling in for the first time, just a little bit about who we are. We're a registered investment advisor headquartered in Atlanta with an additional office in Charlotte. We have a highly credentialed team of professionals with the goal of driving client outcomes in recognizing their own personal net worth wow. Now, we achieve that through focusing on four key pillars of grow, protect, give, and live, integrating strategies in each of those verticals to help our clients to achieve their goals. Now, for today, what we're going to focus on is we're going to be wading through some of the daily noise and focusing on some underlying economic conditions and what that means for portfolio strategy. So here's what's on our agenda. Now, recent readings of the data suggest that the U.S. economy does have some positive momentum. And the global economy is gaining some steam thanks to better than expected growth in Europe and a broad reopening in China. Now, recession could therefore be a problem for another day and be punted out from 2023. Now, much of the media has been focused on whether or not we get this so-called soft landing in this cycle. But we would point out that that really kind of misses the point, that there will be a recession at some point in the future. And what that recession looks like is likely to be quite impactful and important. Now, finally, we've maintained a relatively neutral approach to portfolio construction for several months now. Historically, investors have not really been rewarded as much for taking those major bets as a cycle matures. So we're going to talk about that in a little more detail. And as a reminder, throughout this presentation, you can feel free to submit questions in the questions box. And at the end, I'll take a look at those and answer what I can for y'all. So let's take a look at a really simple look at the economy at large. So what this chart here is showing is nominal gross domestic product, or GDP, in the top clip. And it's showing the annualized quarterly change in GDP in the middle clip and the year-to-year change in red in the bottom. Now, recessions are shaded on this chart, and a few things to note. First, notice that the economy grew at a 7.3% rate last year before accounting for inflation. That's actually a pretty quick rate of nominal growth. But notice how it's been trending lower. In other words, the economy's been downshifting from very rapid expansion to a slower rate of expansion. And that's actually very consistent with the historical pattern for the economy, where you get a recession followed by a very sharp positive rate of growth and then a settling into a slower rate of expansion. So we have a few reasons why we think that recession could end up being a problem for some time beyond 2023. One of those is that the economy is clearly carrying some positive momentum on a nominal basis. So if inflation continues to moderate, real economic growth can remain positive. Second, and probably more importantly, the job market remains quite strong. True, there have been some high-profile layoffs, but on net, those workers are getting reabsorbed into the workforce pretty quickly. And as shown here in the bottom clip of this chart in red, employment trends remain quite strong. Historically, it's taken some notable weakness in employment to confidently proclaim a recession. Trends in employment are a perfect 7 for 7 in calling the last 7 recessions. So until unemployment begins to break, we can't really have any confidence in any sort of recession call. So if there's not going to be a recession this year, or potentially not going to be a recession this year, and remember, there still could be some lagged effects from monetary policy working their way in to result in a recession this year. But if we don't get a recession this year, where in the cycle, where are we in the grand scheme of things? So this chart here shows a stylized perspective of the stock market cycle in the top clip. And that goes along with the economic and earnings cycle in the bottom clip. And from that perspective, believe it or not, this whole cycle since the pandemic recession has actually been following a very normal pattern. We had a recession that included a bear market in stocks. Then we had a very powerful post-recession bull market move, and that lasted roughly a year and a half. Market participants ended up being overly optimistic, and valuations were way too high at the end of 2021. The economy began to downshift in 2022 from that rapid expansion rate to a slower expansion, and a non-recession bear developed in 2022. That bear market potentially bottomed in October, and it's now possible that we're back into more of a bull market construct. Historically, if we are in a bull market, historically, these follow-up bull markets that have not coincided with recession, they've tended to be longer in time, but a lot slower in the rate of return than that post-recession bear market, which those do tend to be very fast snapbacks in market prices. Now, investor sentiment is a huge part of the story. We can see that at the end of 2021, market sentiment was overly optimistic, setting us up for disappointment last year. Well, towards the end of last year, market sentiment was extremely beat down and depressed. These types of pessimistic extremes, that's really what bull markets can be built on and launched off of. Now, interesting, last year was the second longest run of investor pessimism since at least 1995. And in prior instances of long stretches of pessimism, when sentiment finally started to improve, it had meant that the bull market was over. Now, one may point to inflation as a reason to remain cautious this year, and it's true that inflation remains high. We got a CPI print yesterday, and it was 6.4% year over year. And policymakers clearly see that as too high. But for the market, it's not necessarily the absolute rate of inflation that matters the most. Instead, it's whether inflation is getting worse or improving. And on that score, it's improving, which has historically been a tailwind for the stock market. Now, another thing that we can't lose sight of is that the global economy is showing some signs of life now. This chart shows growth trends for the global economy ex-China in blue, and also China on itself in orange. As European growth is improved and China reopens from COVID lockdowns, the data is beginning to show improvement for global growth. Now, the US economy is relatively closed, but it's far from a fully closed economy. Improvement in global growth conditions would also help US growth as the year progresses. After all, US companies derive about 30 to 40% of their profits from foreign operations. Now, as the global economy moves from high recession risk to a lower recession risk, that should be a tailwind to stocks. This chart here is showing global recession probability in the bottom clip. Now, the nomenclature of this indicator on the chart isn't very accurate. What it's really measuring is the probability that global growth is slowing down, not necessarily an outright recession. But note that this indicator did peak back in the fall, and that was pretty coincident with the market low. Historically, the best returns for stocks have happened when global slowdown risk is high but falling, and that's the zone that we're in today. So maybe it looks like this soft landing chorus could potentially start to grow louder throughout the year, or at least early on in the year. But the argument for a soft landing misses the point that the economy is constantly in a cycle of expansion and recession. Now, we're likely to eventually experience another recession in the future, so let's talk about what that could look like. So here on this chart, we're going to walk through a pretty important concept. It models the relationship between inflation, economic growth, supply, and demand. Now, from the middle of 2021 to the middle of 2022, we saw a huge surge in demand without the commensurate shift in supply. Unsurprisingly, economic growth went up, but inflation also went up. But now we've shifted to this kind of next stage that we could call the disinflation stage. Due to falling real incomes and receding stimulus levels, demand has begun to soften and inflation is quickly falling without losing a whole lot of real economic output. Now, this is by and large a positive development, but eventually we're going to get to the point where supply and demand are balanced, and that may look like a soft landing. Now, our friends at BCA Research, they liken this mix where supply and demand are balanced as a seal balancing a ball on its nose. That's because one of two things will eventually happen. Either some shock will come along that pushes demand down further, which will actually result in a recession and a loss of jobs, or a supply shock will come along that sends inflation back up, resulting in another leg of Fed tightening. So thanks for bearing with me through this, but I think it's a really important point to underscore that right now we're going through this kind of benign disinflation phase. It may start to resemble a soft landing, but eventually the economy will recess again. Okay, so we think we're still in that economic expansion, but we're somewhere between mid-cycle and late cycle in the expansion. So what does that mean for portfolios? Well, this chart here breaks out some really big themes by where we are in the cycle. The dark blue bars in each of these are the median gains in the early portion of an economic expansion. The orange bars are in the mid-cycle phase, and the light blue bars are the late cycle phase. So starting with the S&P 500 and stocks themselves, we can see that stocks have tended to gain rapidly early on in an expansion, and then downshift during the mid-cycle portion of an expansion, and then gain at a pretty sluggish rate, but still positive rates of return later on in the cycle. Now, interestingly, stocks have tended to outperform bonds by a similar amount throughout the entire expansion. Now, small caps have tended to be dominant in the early cycle, but large caps have tended to perform a bit better in the latter two-thirds of an expansion. And as far as growth versus value is concerned, the relationship is pretty favorable for value early cycle, but much less definitive as the cycle goes on. Now, this chart here is another way of making the point. Our friends at Ned Davis Research combine 10 different relationships in what they call their early cycle composite. They look at relative trends of small caps, low quality stocks, non-dividend paying stocks, cyclical companies, high volatility names, oversold stocks, small cap tech stocks, financials, materials, and companies with low earnings growth. These are all the types of things that tend to do the best in the immediate aftermath of a bear market. So let's call this the early cycle leaders. Now in red, we're showing the average pattern for the early cycle leaders in bull markets for up to 2.5 years later here. You can see that the early cycle leaders in bull markets that followed a recession, which is that red line, you can see that those areas rallied sharply and they maintained an uptrend for later on into the cycle. Now in blue, we're showing those early cycle leaders following those bear market bottoms of non-recessionary bear markets. And that's where we think we are today. So yes, the early cycle leaders do tend to perform better in the early stages of those bull markets, but notice that they don't do as well as they do in the post-recession bears, and also notice that their relative outperformance has tended to peter out a bit sooner. In other words, investors are not as rewarded for making big overweight portfolio bets in this stage of the cycle as they are following a recession. Now, it may not sound too exciting, but taking a neutral approach within stocks makes a lot of sense in this stage of the economic cycle. Finally, let's touch on bonds. I'd say they're in a similar spot to stocks. This chart here breaks down the yield on various sectors of the bond market. The gray bars are the range of yields over the past 10 years, and the diamonds in each of those are the approximate yields today. The purple line in each bar is the median yield over the past decade. So for bonds, what you're generally getting is a higher yield than you've had in the past 10 years. But back in the fall, these yields were all at the high end of their ranges. We can see that they've since come down quite a bit. And not shown here, credit spreads are pretty tight. In other words, riskier portions of the bond market are relatively expensive. So a bond investor is not really getting compensated to add too much risk either. So a pretty neutral strategy in bonds also makes sense until something changes here. Now, I know some parts of this presentation today were a little bit dense. So let's just recap the high level of what we went over today. First, it appears like there's some positive momentum in the economy and a recession may be pushed off into the future. Now, believe it or not, the pattern from the pandemic-induced recession to present has followed a very typical pattern despite the atypical nature of this cycle. We may be in a post-growth scare bull market now. Now, these can last anywhere from 6 to 9 months to a period of years. It just depends on when we go into that next recession. Now, on that score, it's not really a question of if, but when. Once the economy is fully balanced, there will inevitably be either a demand or a supply shock that creates a recessionary condition. We think that's a little ways off because we're still undergoing that rebalancing phase. Now, within the stock portfolio, excessive risk-taking hasn't really reaped the same rewards as earlier stages of the cycle. And given the current level of yields and spreads, the same may be said for the bond market. So a neutral approach to portfolio allocation, while not sounding that exciting, makes a lot of sense right now. Okay, so let's take a look at our important disclosure information, and I'm going to go take a look and see if we have any questions today. Okay, good. We do have a question on the debt ceiling. So this is really good and front and center news. So a couple thoughts on the debt ceiling resolution. One, we don't attempt to be geopolitical or political analysts, but I will say our friends at Strategas Research Partners do believe we'll eventually land on a resolution to the debt ceiling. However, any sort of scare in the debt ceiling resolution that could result in some sort of downgrade in U.S. debt could send treasury yields higher. And that would obviously have an impact to assets all over the place. So I think that is something that we need to watch. I will say back in 2011, we had a debt ceiling scare. U.S. debt was downgraded. It had a quick impact, but the stock market was actually up about 11% over the next year following that situation. So it's something to keep an eye on. We need to pay attention to what happens to U.S. treasuries around that. But our main research providers that we use for political analysis think that it's going to get resolved. Good question. All right, let me see if there's any more that came in. Okay, guys, that looks like it about wraps it up for today. I want to thank everybody for spending a little bit of time with us. If you have any follow-up questions, feel free to send your advisor an email, send myself an email at tony.welch@SignatureFD and we'll be happy to answer those emails.